Is the 4% rule still safe in a low interest rate environment? That's what we're going to talk about here today, my friends. Deconstructing the 4% rule, or AKA the safe withdrawal rate in a low bond yielding environment. Man, I can't wait to dive into this. So welcome to Heritage Wealth Planning YouTube channel, the place you come to learn about the 4% rule. And of course, we're all familiar with the 4% rule, and I'll dive into what that is exactly here in just a second in case you're not, and that's fine if you're not. That's what I'm here to educate you for. So if you like to hear to learn what we talk about, subscribe down below, and then don't forget the bell to be notified for future content. All right, so let's dive right into this because this article is awesome. So here's my man who I just came across yesterday, Erevn, learning how to enjoy retirement in Vietnam with charts and graphs. And I'm going to try to get this guy you need to follow this guy. And I'll put a link to the show notes, followed by 701 people. Frank, I don't even know if he's still doing a blog post. I'll look, but I think he is. Anyway, you need to follow this guy because he's fantastic. And I'd love to interview him for my podcast. I think I did email him, but off the top of my head, I can't remember. Anyway. This is fundamentally one of the best articles you'll read all year. So deconstructing safe withdrawal rates in a low yield world. So remember, safe withdrawal rates. We talked about that yesterday or 2 days ago. The maximum amount you can take without ever running, or the minimum amount, I can't remember, but the amount you can take without ever running out of money over your life expectancy. So if you say I'm going to live for 30 years, I'm going to take 3.8% a year out. I always have money at my death, be it a penny or $8 billion. That's your safe withdrawal rate. Now, in of itself, I find that to be somewhat silly because it just says, well, what if only 2% of the time you ran out of money, but 98% of the time you had an average of $800,000? Would that, is that still a good use of your retirement resources to say, every single time I had money left, but I gave away $2 billion at my death? No. So safe withdrawal rate is the minimum amount that you can take out, or is the maximum? I think it's the maximum. Yeah, either way, you can't take out more than 4% a year unless you want to have some kind of probability run out of money. That's what the safe withdrawal rate says. So let's talk about what this guy says. Traditional research on safe withdrawal rates tells us that the safe rate is around 4% when using constant dollar withdrawals. That simply means adjusting it each and every year for inflation. So I take out $100,000 this year, I take out $103,000 next if inflation's at 3%. A common objection to that current condition, i.e. the 4% rule, is that yields on treasuries are at record lows, unprecedented in American history, making the findings of previous SWR research suspect. But there has been, unfortunately, little critical analysis of the claim. If a 4% safe withdrawal rate isn't safe, then what is? 3%, 2%, 1%? Enter the auto-regressive bond yield model. And you can see it's like, well, I'm like, wow, okay. That I'm not going to go into that because I don't know what that means, but I'm going to rely on my man, Blanchett, Finke, and Fow, and this Michael Finke, something like that, Wade Fow, and is it David Blanchett, who wrote this article, a seminal piece actually, on low bond yields and safe withdrawal rates, which I read in 2013. It actually opened my eyes to a lot of different analysis in terms of bonds in particular. Anyway. So in 2013, in the Journal of Financial Planning, BFP, Blanchett, Fink, and Fow tried to provide some answers. The paper is a major step forward and better than usual. I don't think 4% is safe given the low interest rates, so I'm going to apply an arbitrary downward revision based on my gut feel. What Blanchett et al., we'll just say BFP, does is conceptually at least straightforward and in retrospect an obvious approach. They interrogate the historical record to see what the relationship is between bond yields, the return on cash, the return on stocks, the return on bonds, and inflation. You end up with a pile of regression coefficients that describe the historical relationships. And this is from BFP. We introduce a model that takes into account current bond yields and allows them to drift towards a higher value during retirement using an autoregressive model. You can then plug in current yields and generate next year return for stocks, bonds, and inflation. This isn't a prediction. It's a model for using Monte Carlo scenarios. So remember, Monte Carlo is a random sequence of events. So 1 year the market might be down 20, the next year might be down 30, 1 year might be down 20, the next year is down 20, and just thousands of different iterations of various scenarios, completely random. And that's about the best you can do for projecting future possibilities. And again, if you look at Nassim Nicholas Taleb, he'll say that's all great in a standard deviation bell curve, but what happens at the end of the day, there are higher fat tails that with the bell curve would discount, when actually in reality things happen that don't fit as neatly into this standard bell curve. And I think they call it a Gaussian model or something like that. My man Benoit Mandelbrot, which is back there on my bookshelf, talks about that quite a bit. And then Nassim Nicholas Taleb does too. So anyway, going forward. So the whole point about that is we do this Monte Carlo analysis. We can say, look, at 1,000 different iterations, this happens 67% of the time, which is one standard deviation. This happens 97% of the time or something like that, which is two standard deviations. And this happens 99.6% of the time, which is three standard deviations. And thus, the likelihood of you being on the extreme of either high returns or low returns is like 0.4% statistically, just not statistically relevant. Nassim would say, no, sirree, Bob. The statistical probabilities when real world events simply don't align. You got to look at the statistical probability and make that suspect because fat tails are out there. And so it's an interesting, what's the word I'm looking for? Dichotomy to some degree. All right. So anyway, going back to BFP, the probability of success or 4% initial withdrawal rate over 30 years for a 40% equity portfolio is 48%. All right. Let me just chomp on that. If you have 40% stocks and 60% bonds, you're taking 40% a year out over 30 years. All right. You're taking 4%. So we're 65 years old. We're going to die when we're 95. We're going to take 4% a year out of our portfolio. We'll just say our portfolio is $100,000. So we're going to take 4,000 the first year, 4,000 plus 3% of inflation the second year, whatever they're using for inflation. There's only 48.2% time that we actually have money at our death. Okay. It's 2.4% if we have a 60% stock to 40% bonds, a 30-year period with a 95% probability of success. So basically, a little bit confusing here, but basically what he's saying is if you want a 95% success rate in this low interest rate environment and you have 60% stocks and 40% bonds, you can only have 2.4% as your safe withdrawal rate. You can't have more than that unless you're willing to take on more likelihood that you'll run out of money. The safe withdrawal rate is only 1.9 in the same scenario, 60% stocks, 40% bonds. If you want a 99% probability of success, which I don't know why you do that, but either way. And then it's 1.3% if you're over 40 years with a 40% bond to 60% stock, 60-40 stock to bond portfolio, 40 years. You can only take 1.3% of your portfolio each year if you want essentially a guarantee. Well, not even a guarantee, but a statistical guarantee. You need to even say go that road, but a likelihood, a high likelihood that you're not going to run out of money. 1.3, it ain't going to cut it. So all these, but now if you want, if you're fine with a 48%, probability and you only want 40% stocks, well, you can take 44% year out. That's what we're saying here. All these numbers are obviously a far cry from the results seen in the traditional SWR. So what's underpinning them? What does sequence of returns look like that generate these safe withdrawal rates? And then this is where my man, whoever writes this guy, I don't know his name, he finds a mistake in the paper. In their paper, BFP provide everything you need to recreate their model in the appendix, which is pretty cool. However, my implementation gave me results that were far off from theirs. After a lot of double, triple, quadruple checking, I finally emailed Blanchett. A quick email exchange helped me track down the problem. Some of the coefficients were printed in the wrong order in their paper. All right, so at the end of the day, I don't know what all this means, but this guy does and Blanchett does too. They just flipped a couple things they shouldn't have flipped. Needless to say, I felt pretty chuffed, or I think that's chaffed, that I was the first person to find this error in their paper. Again, it just goes back to any kind of journal, peer-reviewed journal. I'm looking at tons of stuff on science when it comes to climate change, health and nutrition studies. A lot of studies leave a lot to be desired, even though they're peer-reviewed, that's for sure. And then we actually have something called scienceretraction.com or something like that, where they talk about the guy from Cornell University is in the news lately. He does a lot of food. He did a lot of nutrition, food studies. He was under Bush, under Obama. Everyone loved him, and then he couldn't reproduce his findings. He couldn't, even though they're all peer-reviewed. Everything was based on this guy. He was making millions off his research, and it was all fraudulent. Sad, actually, and that was what we're basing our food pyramids on, which replaced that by the 4-color scheme, whatever it was. This guy at Cornell, all fraudulent. It's across the board. In science research. It's actually disgusting. It's despicable because there are good science papers that need to come to the forefront, but they're being, just like always, anytime the boy cries wolf, you don't know what to believe, and that's so you can kind of throw the baby out with the bathwater. Now that I recreated their model, I was able to start digging to the results to understand them better, the contributions of their assumptions. So despite the title being about low yields, in the paper the authors say the results are due to 3 factors. The model incorporates today's high yields. They reduce expected returns on equities by 2%, and I agree with that. And they assume an annual fee of 1%. That's the big one there. All right. So they're saying at the end of the day, we're only going to get roughly 2% on bonds. We'll get 5.5% on stocks. I'm just off the top of my head. I don't know exactly what they're using for equity returns. I don't know exactly what they're using for inflation. I don't know exactly what they're using for bonds. But they're saying at the end of the day, the PE ratios are higher. Thus, the value stock growth will be reduced because higher PE ratios usually mean lower growth of the next decade. Bond yields are low. You're not getting a higher return on bonds than the current bond yields. It just is mathematically impossible. And we're going to add a fee on there as well. So that's a 3-headed monster there. They don't mention in the paper, but they also assume the bond portion of the portfolio is actually 20% cash. So it's, for BFP, a 60-40 portfolio is actually 60 equities, 32 bonds, and 8% cash. They don't tell us how much each one contributes to the resulting lower safe withdrawal rates, but we can rerun the analysis, varying the parameters to understand the contribution of the 3. Checking for model bias. First, let's set all assumptions to align with those of the traditional SWR research. That means no fees, no reduced expectation returns, 60% stocks, 0% cash, and 40% bonds. And a starting yield that is the same as historical average. So the starting yield on bonds is 5.5, which is high above a historical, right we're at right now, but that is the historical average. That'll help us tease out any potential model bias. Traditional SWR safe withdrawal rate research gives a probability of success in the mid to high 90s for the above assumptions. Again, no discount on stock returns. The current yield is 5.5 and no annual fee. So the 4% rule suffices in historical running of scenarios like we just talked about. That means no fees, no reduced expectations of returns, 60% equities, 40% bonds, no cash. And all right. I guess, already talked about that. The low yield model with traditional assumptions gives a probability of success of 93 to 90%. So it's interesting. Even traditional assumptions with a low yield model still gives us a pretty good probability of success. That matches up with the previous research, so it doesn't appear to have any intrinsic bias up or down. Now, let's set everything back by the details of BFP and varying things one at a time. Now, don't get carried away with the precision below. This is based on Monte Carlo analysis of 1,000 iterations, and the numbers will vary by 2 to 4% in any given run. Yeah, exactly. So our base is 60% stocks, 40% bonds, 1% fee. Our base is 6% stocks, 1% fees, 8% cash, minus 2% reduced equity expectations, and 2.5% bonds. That gives us a 62% probability of success. So not anything you want to write home about. I'm pretty comfortable with that, but that's the base. It's better than what BFP said, simply because we changed the numbers here. We flipped the numbers, and so flipping the numbers gives us a little bit more strength of the portfolio to survive. If we get rid of the cash and keep so remember, 62% probability of success. So now we get rid of the cash and we keep all of our fixed income and bonds. It goes from 62 to 63. Not a huge thing. However, watch this. If we get rid of all the fees, the probability goes from 63 to 74. So now we have no fees and no cash. It goes from 62 to 74%. If we set the bond yields to their historical norms, which I just don't think you should do, it only goes from 74 to 75. If we don't reduce equity expectations, the probability goes from stays at 75. So the two things, The reduction of stock returns and the reduction on bond yields absolutely is not the kicker that determines probability of success. The number one thing is the fees. The fees. Look at that. So basically, under the current probability, with the model being and analyzed correctly, when we flip it, we have a 62% probability. Now, if we just get rid of bonds and go to cash and go to bonds, we have a 63%. So not a huge deal. If we get rid of the low bond yields that we're currently under, it doesn't go. It only goes up to 64% roughly. If we get rid of the low expectations of stocks, this goes again from 63 to basically 1 percentage point more. The big hurdle is the fees. Already we can see that low yields have been unfairly targeted. I'll say Beeline is the only villain. The cash drag is fairly minimal, but the other three seem to contribute equally to the lower success rates. A Boglehead portfolio, and that's over at Vanguard, John Bogle. They have bogleheads.com. Let's change things around to be a bit more reflective of the average Boglehead. We'll also get rid of the cash. We'll also reduce the fees substantially and set them to a 60-40 portfolio of the VTSAX and the I guess that's a bond. I'm not sure what I get. That's some index. Either way, a stock index and a bond index with minimal fees. Let's say 0.1%. There are small fees due to bid-ask spreads, but they're all earnings from security lending. So the true cost of Vanguard's fund can be determined by how much they trail their index. So we'll just say 10 basis points. Even in a low-yield world with reduced equity returns, the probability of success is 76%. That makes me very, very comfortable. The author's fee assumption isn't totally crazy. You don't have to look hard to find people spending 1% or more on advisors and other investing costs. Here's an example of a recent thread by someone who's paying even more than BFP talked about, where you can pay 2%, and you can look at that if you want. Still, let's look for someone who's bought into John Bogle's cost matters hypothesis and only has low cost index funds. We're getting a portfolio of success between right about 75% with all said and done. That's a far cry from the 95% success rate we've seen from the traditional safe withdrawal rate. So it does appear there's a fair amount of truth and concerns about current yields and equity returns. But I'd also argue things haven't changed so much. There's a clear case for throwing away the 4% number as a planning guide. That's spot on. It seems that the biggest lesson in a low yield and low return world is that costs matter even more. Next time I look at what a sequence of return in a low world looks like and whether it has any, we already looked at that one. So costs matter more, the amount you pay for investment management. And I'm going to give this guy a clap because that is freaking awesome. Fees, my friends, fees are the doomsday scenario for your successful retirement planning. I'll do another one where I actually run a couple analysis using my Right Capital software to show you because it's bad. So hope you like this. As always, go to this guy's thing, sign up for him. I love the stuff he's doing. Let's see if he's got anything recently here. Let's see what else he's got. Erevn. So just to survive, he's still doing all kinds of stuff here. So follow this guy, survived the 1970s with debt and guardrail September. So man, I can always, so just safe withdrawal rates with a different measure of inflation, spending. So this guy is fantastic. So go follow this guy without question. As you can see, I'm following him and just learn, be educated on your retirement plans and know what else is out there other than the stuff you hear on Kramer, the stuff you hear on, heaven forbid, finance.yahoo.com. And if you like what you see here, as always, subscribe down below. Thumbs up always help. Comments always help too. Go to the blog at heritagewealthplanning.com and we'll see you next time. Thanks now.